Okay, folks, we're back. I'm Scott Broberg, president of SBR Financial Group, and today we're going to be talking about the Laffer curve part 2. So if you haven't seen the first one where we talked about how we came up with this graph, then I would encourage you to go back and watch that part 1. But this is, in summary, there was an economist in the 1970s, and he's still an economist at the University of Chicago. His name is Art Laffer. He was sitting down in a meeting with some politicians, and he basically drew out this curve that is a relationship between the tax rate and the revenue into the government. And the idea is that we know there's two points. Zero, if you have a zero tax rate, you collect $0. But we also know that if they put the tax rate at 100% for everybody, nobody would go to work. And that next dollar, there's no motivation to earn it, so therefore you would get $0. So we know the curve rises, but at some point it has to fall. Now comes in the debate. Where does this curve fall? That's what we want to find out. This is what all of the economic debates, or at least around rates of taxation, come in. So here's our graph again. Go back here. We have 0 here. We have 100 on this side. And this is going to be, let's say this is a 50. So this is going to be tax rate. And this is actually going to be then revenue into the government. How much does the government collect? And of course, if you just do a very generic curve, it would look something like this. You start with $0 down here. As rates increase, revenue begins to increase. But at some point we know that, hey, this curve has to start coming back towards the 0 again, because we realize this last position is 0 and it has to get back to that point. The question becomes then, at which point on this graph do people begin to decline? Now, just to explain a little bit further what we're saying is, if this was the actual economic graph, the way that it actually plotted out, then what you would want to do as a policymaker, as a politician, you would want to say, look, we're going to set the top tax rate right here at 50%. Let's call that 50%. Because you say, to even raise it one more percentage point to 51, you would actually reduce the amount of revenue coming in. The amount of revenue would come in. So why would you raise that tax rate if the actual money you collected is lower than it was before? Similar to any company that would work in their economics team that would look for a point of diminishing returns, where, hey, we can make 1,000 widgets, and if we make 1,000, we maximize all of our profit. But if we make 1,001, that last one actually put us over the top to where we lost money on that one widget. Well, we don't want to lose money on a widget. We want to gain money. We want to have exactly what we produced match. Okay, so now you get it. All the economists come out and they will do different studies, and you'll get something like this. So some economist will come out and say, hey, we've done a study, and what we've shown is that tax rates will continue to rise, revenue will continue to rise until somewhere, 84, let's call it 85%. And then at which point now you get this very dramatic decline to get back to 0 at 100%. So that might be one study. Then you'll have another group of economists that say, no, we did a study and it looks like this. You have a rapid increase of revenue based on the baseline of people and the amount of money, but it ends, let's say, somewhere at 35%. And at that point, you start getting a decline. And I know that's not symmetrical, but it goes back to 0. Now, what's interesting about this is you'll find arguments for both sides. It would almost be, and just realize too, we used to be out here in the United States, I'll talk about this in a minute, but we used to be out on this side where we had on the marginal, because we have a progressive marginal system, some of the marginal rates on top income earners were upwards of 90%. So we had a system right here. We've thus moved it this direction to where our top rate today is 39.6. Okay, so we've been here before and we switched everything, we moved it back here. So basically what we say is you collect more little bits from more people because the economy is growing and therefore your revenue goes up even though you have a lower tax rate. Now, what's interesting about this is all of us have something called confirmation bias. So if you have the general belief that, well, if you make a certain amount of money, we should be able to tax you at any rate, then you like this plan. This is confirmation bias, just so we know. That's a psychological term where we tend to seek out the ideas that confirm what we already think. If we believe that lower tax rates are the way to go, then we're going to go to this study and say, hey, that this is the one, we think this study is correct. So it lies somewhere on this scale, we know that. But you do have to realize that when there is, it's not simply static. If you raise the rates in this direction, it's not just a static one-for-one increase. There's also an economic. And this can go in two ways. So one is that economically, individuals or people and companies start saying, well, what's the point in trying to earn any more money off of, when we get to above a certain point and we're at 85%, what's the point? We're just going to limit ourselves. We're going to do something else to try to avoid paying this high tax rate. So you get individual avoidance. And it doesn't mean tax evasion, it just means you're avoiding trying to pay any taxes. The second one would be you have economic impact overall. So if the taxation is too high, then you get less money that can flow around the private economy and actually grow the economy. And when you get a prosperous economy, then that's where you get more tax revenues from more people working. Now, there are a couple things that complicate this, so let me talk about one of them here. If you remember from our previous videos, and this is what, actually, let me go ahead and get rid of that. Change colors here, go back to a more color that's easier to read. Okay, so one complication. This is just one of many complications, okay? Is that if you remember, we have in the United States what's called a progressive marginal tax rate system. This is review from our last videos, but it looks something like this. If this is your column of income, then we've got different rates starting at 10%, 15%, 25%, 28%, and this goes all the way up to the top tax rate of 39.6%. And just so you know, in 2014, that 39.6 for a married couple is someone who makes $457,600. So if you're making $457,600 and you add $1 to that, then 39.6 cents of it goes to the government of that $1. Add in state tax, and that's where you can get tax rates around 50%. So basically, you're working for half of the next dollar. So this complicates it. When you hear the high tax rates, we're generally focused on this highest one right now. That's typically where people, whenever we focus on it. So this is complicates the system. Is it's not a flat 39.6 for everybody. It's 39.6 above a certain level. Okay, so for example, if you go back to a little bit of history, so let's go 1958, we had one of the marginal brackets was 81%. And that was for if you made more than 100 and, oh, that's a 4. Let me erase that. Sorry about that. If you made more than $140,000 per year, well, what if we inflate this? And I know it's not a perfect inflation calculation. You would be somewhere around 1.2 million. So this 81% only applied to the next dollar over 1.2 million. Today's dollars. Well, how many people in the United States are making salary 1.2 million? It's a small amount. So, hey, you could raise this, but it's a very small amount of people making over that amount. Also in 1958, you had a 91% bracket if you made over 400,000. Now that's 1958. If you inflate that to today, it's somewhere around 3.5 million. So this is a very small amount of the United States that would be making 3.5. That literally is the 0.1% of the people. So what happens is people say, well, tax them because they've got the extra money. Well, the reality is you can raise that tax rate, but it's not going to bring in the revenue gap that we think. Additionally, these people are typically business owners or highly paid executives, and they'll look for ways that they can create wealth without having to actually pay the taxes, because they can pay creative accountants and lawyers and stuff like that to help them do that. At some point, you get to where, hey, if you put another dollar out there, no one's going to want to work for that. So this is where it does get complicated. Now, if we go back to, let me go back to one of these, I just want to point out that this does not solve the problem. So we did not solve the problem. I need to actually go to that layer. So we did not solve the problem. The problem is, where's the point where we maximize? And the reality is we don't know that. That's not the point of this video. The point of the video was to show you that there is a direct relationship. And at some point you have to get back to zero. You can't raise tax rates forever. And this will then help us get a picture of that. Okay, so for more information about your taxes, make sure you check out our other videos. Or you can go to our website, sbrfinancialgroup.com. I'm Scott Broberg. We'll see you next time on the video.